Well, good afternoon, ladies and gentlemen, and good morning to those of you who might be joining us from the Central Time Zones, the Mountain Time Zones, or the Pacific Time Zones. I also want to say good evening to those of you who may be joining us from across the pond, out in UK, possibly parts of Europe or Australia or Asia. Welcome to today's presentation, a new presentation. No one's ever seen this before. In fact, I just finished working on some of the slides about 5 minutes ago, so it's almost new to me as well. Today, we are going to address some of the frequently asked questions that come up when investors are researching or analyzing the radioactive trading techniques. We're going to start off by briefly reviewing what is the initial setup of the radioactive profit machine. What are we looking to do when we first set up a position, and then of course we have the 10 different income methods after that to reduce the risk and potentially bulletproof the position. And once we take a look at that, we are then going to compare it against a few of the common questions that are asked, well, couldn't I do better if I did this instead? Instead of buying the stock and buying the put, what if I did this? What if I used a naked put to get into the stock at a discount? What if I used a long call substituting the stock, so I had a long call plus a long put, and in the money long strangle? Or the big detraction, of course, isn't this the same thing as an out-of-the-money long call? We're going to address those three. And then if we have time, we have 2 sections of bonus material where we're also going to talk about the effect of commissions on radioactive trading. And of course, the other one we are going to look at is comparing setting up an initial RPM based on the rules of the blueprint versus going deeper in the money looking for lower risk. We'll explain a little bit more of that when we get to it. If we're running out of time, we'll save the bonus material for a later presentation, but I think we will have the time. All right, well, we've got a lot to cover, so let's go ahead and get started. The first thing I wanted to mention, of course, is that in each section I just mentioned, comparing the naked puts or calendar put spread to the RPM technique, comparing the in-the-money long strangle to the RPM, or comparing the long call to the RPM, I have a space left for questions at the end of each 10 or 15 slide presentation. So during the presentation, since I'm flying solo today, hold your questions until we get to the question break. And if we have to, we'll go back and look at the slides that pertain to those questions. But you will have breaks during the presentation to ask questions, and I ask that you hold your questions until then. Of course, if something's going wrong, you're having problems seeing the screen, or there's a problem with my audio, use the question pod and send that to me as well. And I'll take a look at that and see if we can correct that issue. All right, so first, let's start off with what is radioactive trading? Well, radioactive trading is a unique limited risk technique that was developed by Kurt Frankenberg. Now, Kurt, like many of you might have done, spent about $3,000, $3,500 to attend a weekend seminar to learn how to trade covered calls, calendar spreads, and some credit spreads. Now, he followed his guru's advice, and he had some good success in the first 2 months. And the 3rd month, his covered call guru told him, hey, you could do a lot better if you were trading on margin. Well, Kurt didn't pay attention to the risks. He did that, and he promptly lost all of the money he had set aside for investing. But rather than give up, he started over, but he started looking at different ways, realizing that the real problem with trading is not gains, is not having more gains than losses. It's limiting your losses to a single-digit amount in order to kind of skew the market in your favor. So we've developed a technique that focuses on limiting risk first. The positions he opened only have a single-digit risk of the capital he invested, and then he uses 10 different income methods to limit that risk and potentially bulletproof the position. We'll talk about bulletproofing a little bit later on in the bonus materials. Now, the main crux, of course, of what this technique does for us at the initial setup is we've all heard this axiom: cut the losers short, let the winners run. Not lets the winners run. I'm going to apologize for that. Let the winners run. The same thing as buy low, sell high. Now, that's a great thing to do. That's what we want to do in the market, but do we always do this? No. We're usually introduced to strategies that actually cut the winners short and let the losers run. Or positions where we can have maybe a small percentage gain and have a very high leverage risk, and that's not where we want to be. All right? Now, my name is Mike Chupka. I'm the Director of Education here at Power Options. Power Options is a patented suite of search and analysis tools for self-directed options investors. I've had the great pleasure of working with Ernie Zarena and the Power Options staff for the past 8 years. Ernie is the president and founder of Power Options. I started out the same as most of you. When I first started working with Ernie, he taught me how to do covered calls and naked puts. after about 18 months, almost 2 years, I decided to branch away from that, and I started trading standard collars because I was having good success as Kurt did. Luckily, I never had a loss that wiped out my whole portfolio, but I was having losses on my covered call and naked put trades of 15%, 20%, wiping out 5 or 10 previous gains, getting back to square one and starting over. So that's when I started doing standard collars. That was about 2 years into my investing, so about 6 years ago. Now, I came across Kurt Frankenberg 3 years ago. He was using the power options tools, and he called up for a coaching session to learn how to identify the RPM positions and do some paper trading and back testing. And of course, I showed him how to use the tools and how to identify the positions, but when I first saw the setup, I had the same comment or argument that most of you had. Well, I understand that you're limiting risk, Kurt, but you're putting in a lot of extra capital in this setup. You're increasing your cost basis, so I don't see how you're going to make a profit. Well, Kurt invited me to one of his free webinars and showed me exactly how he makes profits with these techniques. But I went through the same process that most of you went through at this point that we're going to go through today. As soon as I looked at it, the initial RPM setup, I said, couldn't I do better if I did this instead? If I used a naked put to get into the stock at a discount and then bought the insurance policy? Or what about using an in-the-money long call instead of the stock, so I'm putting up less capital? Isn't that better? Or isn't this the same thing as a long call? But over time, really only 4 or 5 months, and talking to Kurt and running through the same comparisons and actually trading some of those alternative techniques that we're going to look at today, my conclusion is that the RPM is superior to those positions. You're more than welcome to comment against that during this presentation. You're more than welcome to make a comment that's contrary to my thoughts, but I feel that this position is superior, and we'll talk a little bit about that as we go on. I have had more success with the radioactive trading than I had with trading covered calls, with the naked puts, and with when I was doing calendar spreads for about 2 years as well. Because the problem was with those 3 strategies, I always eventually suffered a loss that wiped out some of my previous gains, and I ended up back to square one. With these radioactive trading techniques, I know going into the position I only have single-digit risks. And when I lose, I'm only losing 3, 4, maybe 5%. So I only need a 5% gain, 5.3% gain or less on my next position to get back to break even. All right, now before we talk about the initial setup of an RPM, oh, they didn't save. I apologize. I did create 2 polls, but they did not save. Okay, so that's not going to be an issue. The 2 polls were really, I was just going to see what your experience is with radioactive trading, and also I was going to see what your experience is with options right now, what kind of strategies you're trading. But that's okay. The presentation here is basic enough but in-depth enough that everyone should be able to follow it. So I apologize for that slight delay. Let's talk about the initial setup of an RPM. An RPM stands for a radioactive profit machine. That is the initial starting point of the radioactive trading techniques. It is a married put position, but it's a unique combination over a standard married put position that you've read about. If you've read any free information, online information, or information as your broker, you've probably seen a married put or a protective put described as buying stock and at the same time buying a 1 month out of the money put option. By out of the money, I mean if I bought a stock at 35, I might buy the August 30 put for 50 cents or 60 cents. So I have insurance in place in case of a catastrophic event, but the problem is that $35 stock needs to drop 5 points before the insurance policy kicks in. So I'm really risking $5.80 on a $35 stock, and that's too big of a percentage to risk on any one trade. We're about 15, almost 20% at risk on that position. Not quite 20%, but let's say 15 to 17% at risk. Okay. What the radioactive trading technique does, the initial setup is we're going to buy stock, but we're going to buy an in-the-money put that is at least 5 months out in time. Now, those of you who are familiar with long call buying or long put buying, speculating on a market move, you know that options are set up a lot like insurance for your car. So for example, if your car insurance is $100 per month, if you pay month by month by month, your total year cost will be $1,200. If you tell your insurance company, I would like to pay semi-annually, and they'll give you a little discount. They'll say, okay, well, if you pay twice every 6 months, we'll only charge you $550. Okay, so at the end of 12 months, you paid $1,100. But if you go out further and you tell your insurance company, I'd like to pay the whole policy up front for 1 year, for 12 months. They'll say, great, we'll give you another discount. We'll only charge you $1,000 for the year. Options are the same way. If we buy an option that's 6 months out in time, whether it's a call or put, it won't be 6 times the cost of the near-term option with the same strike. We get a discount per day when we buy further out in time. So by buying the stock and buying an in-the-money put that's at least 5 months out, we're able to have single-digit risks on our positions. All we're risking is the time value portion of the put option because the intrinsic value is taken care of, and we have more time for the stock to move in our direction, and we're paying less for the insurance per day as opposed to if we bought the put month by month by month. What I just described is this takes advantage of the 3 core principles of radioactive trading. The at-the-money bell curve, forcing an ideal size trade, or what Kurt refers to as fist, and of course the radioactive decay line or the time decay line. We'll talk about that a little bit later as well. This is a bullish strategy. A married put is a bullish strategy. So when we search for an RPM that matches our limited risk, our percentage that we're willing to risk, and is at least 5 months out in time or more, we also want to look for stocks that we feel are moving up in price. Okay, we're not going to get too much into that today. Let's move on and talk about a basic view as an RPM. This is the stock and the position that we're going to use for our comparisons today. The stock is PXP, Plains Exploration. Excuse me. And on 6/20/2011, on June 20th, 2011, we could buy shares of PXP at $35.08. At the same time, setting up the RPM, we'll buy a January 2012 40 strike put at $7.25. All right? So this put option, we're buying a 40 strike put that we're looking at June, so we're about 7 months out in time to January 2012. This in-the-money put, well, essentially it's $4.92 in the money. So of this $7.25, $4.92 is intrinsic value, and the $2.33 that we're risking is the time value. So we're only risking the time value on the position. Yes, the total cost invested is $42.33, but we're guaranteed to get at least $40 back, so the maximum risk on the position is $2.33 or 5.5%. Now, it's important to note that this maximum risk of $2.33 will only be realized if we hold the position all the way to expiration, the stock's still trading below $40 per share, and we've made no adjustments. That's not our goals. That's not our approach. We typically will only realize this maximum risk when those 3 things occur. Well, here's just a breakdown from the power options tools of the position. The break-even at expiration is $42.33, our total net debit into the position. If we traded 100 shares, we'd have $4,233 invested. We'd be risking $2.33, and we have an infinite upside profit potential. Okay? Standard profit and loss chart for the PXP position. Now, of course, this screenshot was taken today, or last night, I'm sorry, and this morning. And PXP is at 39.27. What I want you to note is the blue line here, the blue hockey stick graph, is the profit and loss at expiration. And this sort of purple line here, this vertical purple line, that's showing us the break-even. Again, only at expiration. The curved red line, even though we have $4,233 invested, or a break-even of $42.33 at expiration, this curved red line is showing the profit and loss at the halfway point, halfway between now and January expiration, which happens to be October 27th. So because of the way this position works, because the put does not lose one-to-one with the stock, especially when you buy in the money and go further out in time, we can realize a profit. We don't need the stock to be trading at $42.33. We can realize a profit beforehand. Yes, we're going to look at the comparisons of where a profit stands on some of the positions that we're comparing today. All right? So that's the standard married put setup. Those of you who haven't seen the profit and loss chart of a married put before are probably looking at this and saying, that looks like the profit and loss for a long call. We're going to get into that comparison at part 3, remember. All right, well, let's move on to the first discussion. Well, we've created a low-risk position. We essentially have stock with an insurance on it. It results in a positive delta. The delta of that put option at the time it was purchased was about negative 0.64. Stock has a delta of positive 1. We're looking for bullish stocks. So as the stock moves up, we're not gaining one-to-one. We're giving some of it back. But we start off with a positive delta of about 0.36 in this scenario. However, that delta changes as the stock moves up. Once it moves up 1 point, the delta is probably going to drop to maybe negative 0.58, negative 0.57. It's increasing in our favor. And this, of course, this takes advantage of the 3 core principles, the at-the-money bell curve. Options have the highest premium when they're at the money. When the stock's trading right at the strike price, that's when an option will have the highest premium. That's where we want to sell. Where we want to buy is on the wings, when it's out of the money or in the money, because when we're buying, what we're really paying into is the time premium. So as on the bell curve, as we go further away from at the money, we have lower time premium in the money and out of the money. So we want to buy time cheap and sell time dear. The red line is the radioactive decay line, as Kurt refers to it. It's the time decay line. And what that basically shows is that when you have an option, the time value really hits rapid decay in the last 2 months, or the last 60 days before expiration. The reason why we're buying put options that are at least 5 months out in time is because the time decay is very slow over the first 3 months of that option. And then in the last 2 months, it really starts to decline. So we want to retain most of our time premium, and yes, we're looking for stocks to move up in price. But the FIS, the forced and ideal size trade, that's going to become very apparent to you as we start going through the 3 comparisons. That's really the crux of the 3 comparisons, is that the risk of over-leveraging, over-trading, but the RPM, the married put position, allows us to force an ideal size trade. These are the 3 core principles of radioactive trading. They're detailed in the blueprint and, of course, on one of Kurt's CDs, The Foundations of Radioactive Trading. So we have really 2 basic components. Let's not get confused in the math just yet. Let's not get confused on the structure. Let's just look at 2 components. What do we have? We bought stock, we're long stock, and we're long an in the money, far out in time put option to reduce our risk to single digits based on the rules in the blueprint. But aren't there cheaper ways to potentially own stock or mimic stock ownership? The first thought I had when I saw Kurt's techniques is I said, okay, I see what he's doing, but I bet you I could do better if I sold a put option. If I found an RPM that I wanted to trade and I sold a put option to try to buy shares of stock at a discount and still had the long put in place. Well, if I was right, that was correct. But what are some of the problems with this? Many investors use the naked put to enter into stock ownership, to buy stock at a discount. We sell a put option, typically near term, 30 to 45 days out in time. When we sell a put, our obligation is that we may be forced to buy shares of stock at the strike price. So looking at PXP, if I sold the 35 strike put and the stock was trading at $34 or $33, I'm going to be forced to buy shares of stock at 35. However, I collected a premium up front, so my cost basis is going to be lowered. I essentially bought stock at a discount. By itself, it is a parity trade to a covered call position. Limited risk on the upside, assuming that you don't roll the position or make an adjustment, and potentially large losses on the downside, okay, if the stock collapses. So our particular position that we might have looked at is on 6/20/2011. Remember, PXP was trading at 35.08. We could sell to open the July 35 put for $1.24. Good rich premium, 3.7% naked yield, which is our maximum profit as long as the stock stays above 35. The stock's trading above 35, July expiration. Our put would expire worthless, and we'd keep the 3.7%. The maximum risk is, well, I multiplied this by 100. The maximum risk is $33.76 per share. If the stock went bankrupt, I'm still going to be forced to buy shares of stock at 35. We keep our $1.24 premium, or $124, but we put out $3,500, so we could lose $33.76. Yes, that is an extreme situation, but we've got to keep in mind that is the true risk on the position. What does this do? This cuts the winners short and lets the losers run. Okay? This is a standard profit and loss chart of our naked put position if we sold the 35 call, 35 put at $1.24. Maximum profit is 124. Even if the stock went up to 100, we don't get any further gains. Our gains are capped because we sold the put option. The most we can make is $1.24. And then if the stock collapses, again, if it dropped down to $20, let's say, we'd have to be forced to buy shares of stock at 35. We keep the $124 premium, or $1.24 premium. We really have a loss of $15 on the trade. Okay. All right, and this is a similar profit and loss chart of what you'd see for a covered call. If we did buy PXP at 35.08 and sold the July 35 call, similar risk-reward profile. Okay, but we're trying to limit risk, so we're going to use the naked put to potentially buy shares of stock at a discount. But what if we also at the same time buy the same put we were planning on using for an insurance policy with the RPM technique? So we sell the July 35 put at $1.24. Buy the January 2012 40 put that we would have in our RPM for $7.25. So our total debit and the total risk is $601. we could potentially own stock at $33.76. If the stock was trading just below 35 at July expiration, we'd be forced to buy shares of stock at 35. We keep the $1.24. So now we have a stock with a cost basis of $33.76 and a 40 strike put at $7.25. So we'd have essentially $41 invested and only a risk of 40. That can work, but what's the problem? Well, again, we're risking 601. Remember, on the married put position, we were only risking 233. So we're almost 3 times the risk, a little bit more than 2.5 times the risk, and we have capped our gains. We have a maximum profit of $92 or 15.3%. But most investors who trade the calendar spreads will tell you that they're going to continually try to roll the position. Okay? Okay. Oh, John, I'm going to get to that question in about 5 more slides. We have about 5 more slides on this segment, John, and then we're going to go ahead and I'll handle that question when we get to that point. Okay? All right. So the initial setup, here's our calendar put spread. Now, this is the problem I ran into on this trade. When I started to do this instead of the married put position, instead of the standard RPM position, the big risk is if the stock moves up in price. When I used the Power Options tools to identify an RPM, and then I did my further research and analysis, I'm looking for the stock that I felt comfortable with would move up 5 to 8% in the next 30 to 60 days. That's now a problem, isn't it? If my stock starts to move up 5 to 10% in the next 30 days, I'm going to start losing money. I've sort of reversed the main goal of this position by entering it with the short put option and the long protective put in place. Okay, now I do have a limited risk on the downside. If the stock collapses, we're going to have a limited risk down on the downside as well. Put's going to gain in value. We will be forced to buy stock, but we had that insurance policy in place and we collected $1.24 against it. One of Kurt's popular themes, popular sayings for radioactive trading is, don't time your trades, trade time. The real risk with doing, well, not the real risk, but part of the risk with doing this calendar put spread is I need the stock to be trading right in this area at July expiration. Yeah, I spent 20 minutes, 50 minutes, maybe 30 minutes looking for a stock that I'm expecting to move up 5 to 8%. But now I'm saying, you know what? Now I really want the stock to kind of stay where it is in the first 30 days, and then in the next 60 days, I want the stock to go up 10%. That's really timing your trade, okay? I'm not that good of a trader. I can't pinpoint where a stock's going to be trading in the next 30 to 45 days, okay? If the stock's trading right around 34 or 34.50, that's fantastic. I get the stock put to me, I have a lower cost basis, I only have $1 risk on the position, and I'm expecting the stock to move up in price after that. Problem I always ran into is when the stock starts moving up, the delta is not in your favor. If my stock moved up 3 or 4 points, I have to try to scramble. Really, the break-even point. If the break-even point for just the put option, if you reference a long stock, what I mean by that is that we're keeping $1.24, and we have a 35 strike put. As soon as the stock moves up to $36.24, I probably want to buy to close that put and buy the stock, because if the stock goes up to 38 and I buy the stock at 38, well, now I'm in a much worse scenario than if I just open the RPM to begin with. Okay, that's part of the issue. Okay, those are the 2 problems. Those are a few of the problems. We were looking for a stock that moves up in price. Now if that happens, we're in a loss. We're timing our trade because we're expecting the stock to be right in that area at expiration, or right around $35 at expiration. Really, as soon as the stock starts to go up to this point, this first break even, 36.24, I want to buy the put back. It will have dropped in price, but I need to buy the put back and buy the stock. Because if I have to buy the stock at 37 or 38 because I'm expecting a run up in price, I'm going to be in a much worse scenario than if I just open the RPM to begin with. Okay? And yes, there is a limited risk on the downside still, but there's a big risk on the upside. All right. Now, let's move on. Would help if I didn't have the pen tool on. There we go. Okay. So, should have been here, but I apologize for that. So we're trying to time our trades. That's the difficulties with using a calendar put to enter an RPM. We don't want to time our trades. We want to trade time. We need the stock to be trading right at or just below the put strike price at expiration. If the stock goes up, we can expect large losses, or we can suffer large losses, and may have to scramble to buy stock when it moves up in price because we're losing delta. And really in this scenario, if you choose to do this, I won't advocate it, but if you choose to do this, you want to take you have a strike price of 35, we had a put premium of $1.24, As soon as the stock hit 36.24, I want to contemplate buying the close, the put, and buying the stock. Because if I end up trying to buy the stock at 38 and I still paid $7.25 for that 40 strike put and only collected $1.24, I'm going to be in the 9 to 10% risk range, and that's not where I want to be. All right. So the RPM quick versus the calendar put. Remember, our RPM maximum risk was 233 or 5.5%. The calendar put is almost triple that in this scenario, of course. It would have been $6.01 or 100% of the investment. The RPM forces an ideal size trade, and we're going to use this comparison, we're going to explain this comparison really well, really in depth when we get into the long call discussion, okay? With the calendar put, I'm only paying 601. Remember, with the RPM, we were paying 42.33. So that means that I could overtrade. I could potentially invest 7 contracts, 8 contracts, and have that risk investment of about $4,233 if I did about 7 contracts. But then I'd be risking 100% of the 42.33 instead of 5.5%. That's forcing an ideal size trade. Our RPM has unlimited upside and a limited risk, and the calendar put has a capped gain to start. John's asking a question about rolling it and letting the stock get put to you. But to start, we have that capped gain, and all the risk is to the upside. And remember, that's what we were doing. We were researching and analyzing a stock that we were expecting that would move up in price over time. Okay? Now, that's my comparison. That's my thoughts. Let's take a few questions on the calendar put and the RPM before we go into the in-the-money long strangle. John's question is, why don't you wait to buy the put until the stock is put to you? 2 problems in my opinion with that, John. Number 1, and we've talked about this, you know that I don't trade covered calls or naked puts anymore. The reason why is because I have that large risk to the downside. So I wouldn't open just a naked put because I'm not comfortable with the at-risk amount if the stock has a sudden gap against me or there's a black swan event. Okay? Now, the other trick, John, is if I sold the 35 put for $1.24, when we were looking at the position with the stock at 35, remember, our 40 strike put for January was at $7.25. If the stock collapsed to 33 or $33, $32, and we were forced to buy the stock at 35, but our cost basis was $33.76. Well, we've lowered the cost basis on the stock, but now the put's going to be $9 or $10. We might look at a different put. You're absolutely right. With the stock at 33, we might analyze a 38 strike put or a 39 strike put. But that same 40 put that we were first analyzing would have too high of a cost right now. It's deeper in the money, but it would have too much of a higher cost. These are another reason why I don't think it's a good idea to try to use the calendar put to enter into an RPM or use the naked put first. John, I know, trades naked puts, and we've had some discussions on him, and he's actually, excuse me, ladies and gentlemen, he's actually better at them than I am. He's had better success with the naked puts than I have. Again, I'm trying to relate my thoughts and my comparisons, what I lived through when I first started trading the RPM and I tried these techniques. You might be a better investor than me. You might have a better stock selection process. And if you can pinpoint where a stock will be trading on a given date or within a reasonable range, that approach might work for you. I can't. Whenever I get a call at Power Options from a customer who's trading something such as a short straddle or an iron butterfly position, or a all-call butterfly, where you really want the stock to be trading right at the strike prices, I tell them these are not positions I trade, number 1, because I'm not comfortable with the risk that's involved with those positions, especially short straddles, where you're selling a call and a put at the same strike price. I'm not comfortable with the risk, and I can't pinpoint a strike price where the stock's going to be trading the next 30 days. If you can do that, you don't need my help. You're a better trader than I am. And John, I'm not saying that it's a bad approach if things work out for you. I'm not saying that. I'm just saying that I had difficulty making that work for me. All right. I don't see any other questions on the calendar puts comparing to the RPM, so let's move on. Again, let's review our 5-line setup for the PXP radioactive profit machine. Buy shares of stock at 35.08. January 2012, 40 put at 7.25. This was on June 20th. Total investment of 42.33. And the total at risk is 233 or 5.5%. What is another way of mimicking stock ownership without putting up the capital? Well, what about if we use a long call instead of stock? We're not talking about just buying an out-of-the-money long call, what some consider to be a parity trade of the married put position. We're talking about mimicking stock ownership by purchasing an in-the-money long call with a higher delta. But we're also going to keep the in-the-money put for protection. Okay? So the lower cost mimicking stock ownership, we buy an in-the-money long call with a higher delta. We're paying less premium into the position, less capital. Then the call will increase as the stock moves up. Can I substitute a long call for stock and do better than the RPM? My answer is going to be no in all the examples that I've run, but there's of course a caveat. But let's take a look at this comparison. A standard long strangle is referred to as a combination of buying an out-of-the-money long call and an out-of-the-money long put. Not to get involved in the numbers, let's say we're looking at PXP, I might have bought an out-of-the-money 40-strike call and an out-of-the-money 30-strike put option. Okay, right between, so the stock's right between the two strike prices. Now, when we substitute the stock with an in-the-money long call and combine it with that in-the-money long put that we're going to use for insurance, we call it an in-the-money long strangle because both the long call and the long put are in the money. They both have intrinsic value and they both have time value. Of course, the expiration date for the call and the put will be the same. Now, a strangle, either an in-the-money long strangle or an out-of-the-money long strangle, does have infinite profit on the upside and the downside. And there's a little asterisk there because the downside gain is kind of limited. If the stock went to zero and we had purchased the 30-strike put, well, we'd be able to sell to close it for $30, of course, but we can't get any higher than that. But it's still pretty much infinite risk to the infinite profit to the downside. The risk is the cost of the time value for both options. If I did an out-of-the-money long strangle, that would be all time value. If I'm doing an in-the-money long strangle, only a part of the cost of the ITM call and ITM put are time value. All right? So where did we stand on June 20th with PXP? Again, it's at 35.08. Well, remember, we're going to buy our January 2012 40 put at 7.25. This put was 14% in the money. 5.5% of that 7.25 was time value, which equated to our natural risk on the RPM. And it had a delta at the time of negative 0.64. Puts have a negative delta. When I sell a put, excuse me, I'm taking a negative on a negative delta, so it turns out to be a positive delta if the stock moves up. Now, I know a question's going to come up on this, and we'll have a section at the end to discuss it. But let's say at the same time, instead of buying stock, PXP at 35.08, we want to reduce capital by buying the January 2012 30 call at 7.35. It's about the same amount in the money. It's 14.5% in the money, 5.8% of time value. 5.8% of our 7.35 is time value, and it has a delta of about 0.77 on June 20th. And look this up using the historical chains on power options. So our total invested is the 7.25 plus the 7.35. We're purchasing two call options. Sorry, we're purchasing two options, the call and the put. Total invested is 14.60, but the maximum risk in this case, since it's an in-the-money long strangle, is not 14.60. It's only 4.60, or 31.5% of what we invested. You can kind of tell where I'm going with that when I show 31.5%. Okay, and the reason why it's only 4.60, again, here's just the breakdown. If we did one contract of each, it would cost us $735 to purchase the January 30 call, $725 for the January 40 put. So our total invested is $14.60, and risking $4.60, or 31.5%. The gain is essentially infinite again on the upside. The stock goes to infinity, the call will continue to gain to infinity. If you ever find the stock that you feel is primed to move up to infinity, call me and let me know because I would like to trade that with you. In any case, because of the two legs of the particular strangle, we end up with two break-evens, a lower break-even and an upper break-even. And again, when we look at the profit and loss chart, we see that, of course, is just at expiration. But let me go back and remember with our investment, we know we're not going to hold the position all the way to expiration. We're not planning on holding the RPM to expiration. We wouldn't plan on holding the in-the-money long strangle all the way to expiration. But look at this second break-even. The upper break-even's at 44.60. The break-even on our married put position at expiration was only 42.33. So this gives us a higher break-even because we paid two time values. We're not just risking or had to pay into the time value of the put. We're also paying into the time value of the call option. Okay? So we have a wide spread here. We need a significant movement to realize a profit on the position, even at the halfway point. It almost looks like we need the stock to be at 28, or maybe at about $41 here to see a break-even at the halfway point, halfway between now and January expiration. All right? Okay. Now, the difficulties with the in-the-money long strangle is you're increasing your maximum risk due to buying into two time values. The start of the position is delta opposed. I I don't like to say delta neutral. In my opinion, with this, it's delta opposed. When I first opened the position, we had a negative 0.64 delta on the put and a positive 0.77 on the stock. If it moves up 1 point, we're going to gain a delta of about 0.7 or about 7 cents roughly. If the stock drops, we're going to lose a little bit more at this point. The delta of the call was 0.77, so we lose 77 cents and gain 64, so we're down about 13 cents. So I consider that delta opposed. That's why you need the larger movement on the stock than you do on the RPM to realize a profit. Lower capital is used. Yes, I can't argue that. You invested $1,460 for one contract of the call and the put. I invested $4,233 for 100 shares of stock and the put position. Lower capital is used, but that means increased risk for overtrading and increased percentage risk. Remember that percentage risk of 31.5% on the in-the-money long strangle. And the reason why I say every scenario that I've run, I haven't run every single scenario that's out there, but I've done 3 examples with for customers, white papers on comparing the IBM in the money long strangle to the married put, one on IWM and I believe one on Humana. And with a reasonable movement in the stock price in the first 30 days, I've seen the married put gain more of a profit than the long strangle. Yes, if there is a significant movement, if we hit an earnings and the stock jumps up 30%, I bet you the in-the-money long strangle will outperform the married put as far as an unrealized profit goes. But in general, with standard market movements, the RPM realizes a profit before this in-the-money long strangle. I want to take a look at that real quick. I did have a question come in. Let me see. Pushkar asked a question that I don't know if I'm going to get to later on, because later on in some of the bonus material is where I wanted, it looks like we are going to have time to do that, but later on in the bonus material is where I was going to discuss looking at out of the money versus the deeper in the money married put and so forth. But if you use an out of the money put instead of the in the money put, Pushkar says the break even and max risk should go down. No. That's not true at all. Pushkar, can you clarify this for me? You say if we use the OTM put instead of the ITM put, the BE and max risk should go down. How does this compare with the married put? Pushkar, are you referring to using an out-of-the-money put in combination with this in-the-money long strangle? So buying an in-the-money call and then buying the out-of-the-money put? Because if you do an out-of-the-money put, okay? Okay, good, Pushkar, that's what you meant. I'm going to try to illustrate that for you. Okay, I'm going to try to illustrate that for you in a minute. I want to get to the Power Options suite of tools to show this position. Okay, Tom, I'm going to handle your Thomas. I'm going to handle your question in just a moment. Okay, Thomas as well. I'm going to handle your question at the break. Let's get into the portfolio. All right, so we'll come back to this. I've created portfolios on the Power Options account for the comparison between the two positions. Here's PXP with our values we were looking at the RPM, shown a little bit differently. We're not looking at the 5-line setup now. But remember, we bought stock at 35.08 on 620, bought the January 40 put for 725. Here's our comparison with buying the January 30 call for 735 and buying the January 40 put for 725. Okay? So we know our total invested in both positions, $1,460 versus the $4,233. Stock is currently at $38.29. It was up at over $39 this morning. It's dropped back down again. But that's a reasonable move. I mean, we're still up 9% from where we opened this position. Our calls gained 30.6%, and the put has dropped 29%. Earlier this morning, it was different. Okay? It was a little bit different value. When it was up at 39, the call hadn't reacted quite as much, and the put had declined more. But let's take a look. Where do we stand right now? Oh, I'm sorry. Where do we stand right now with the gain or loss? Well, we can see with the married put, oh, sorry, ladies and gentlemen, let me get over here. There we go. We can see with the married put that right now we have a gain of 2.6%. Now, I know this is pretty far off here. We're in August. We're about a month and a couple days in. We've been in the position for 43 days, and we're at about a 2.6% gain. Well, we haven't done any income methods yet. We're just doing the straight comparison. So we've gained $111, $321 on the stock, lost $210 on the put. So there's our $111 gain. We've only gained $225 on the call. We've lost $210. That was terrible. We've lost 210 on the put. So right now we only have a gain of $15. But this is a reasonable move. This is more than a reasonable move, isn't it? 9.2% over 43 days. It's a good stock from where it was. From 35.08 to now trading at 38.29. It was up over 11% this morning when it was around 39.20. Okay? But see, that's a reasonable move. Every comparison I've run, and I mentioned on those white papers, every comparison that I've run, in an average stock market over a 30-day or 60-day time period, when you see a stock move up 5%, 8%, 10%, the married put is showing a positive gain. The call will never have a true delta of 1. Can't have a true delta of 1. And if you find a call that's deep enough in the money and far out in time that has a delta of 1, I can guarantee you it's going to have no open interest and no volume. You're not necessarily going to get filled at the price that they're showing. Okay? So that's the reason, yes, I put in more capital, but I'm realizing a positive delta as the stock moves up as I expected. Okay? That's what I meant by in my opinion, the married put is always superior to this in-the-money long strangle, because as the stock moves in a reasonable market, you're going to realize a better profit, or you're going to potentially be able to realize a better profit on the married put position over the in-the-money long strangle. Regular market moves. If this stock jumped 30%, if it jumped up, let's say, maybe moved up 15%, almost 40% because of some grand earnings or something of that event, is trading near $50 per share, I'm probably going to say that your in-the-money long strangle is going to beat my married put position. How often does that happen? Okay. All right. Let me navigate back to the slideshow here. We're going to come back to power options in just one moment, but I want to do a quick comparison here. Here's my comparison for the RPM versus the in-the-money long strangle. And I'm going to handle those couple questions and jump into the next section. All right, the RPM max risk was 233 or 5.5%. Of our investment, the in-the-money long strangle is risking almost double that, 460 per contract, or 31.5%. Again, I'm forced into an ideal size trade, and we're really going to emphasize that in the next section. With this leverage, I have the risk of over trading. What if I did 4 contracts now and got closer to that $4,200 investment? I'd be risking $1,600, $1,700 of that $4,200 investment. Okay, that's not what we want to see. We don't want to take positions that could have a 31.5% risk. Again, I have to be fair. With this in-the-money long strangle, that 31.5% risk or loss would only be realized if we held the stock all the way to expiration. The stock was trading between the 2 strike prices, between the 40 put and the 30 call, and we did no adjustments. Okay, we start off with a positive delta on the married put position, the RPM, and the in-the-money long strangle starts off with a delta opposed position. It's not neutral. I don't like saying the in-the-money long strangle is delta neutral. I feel it's delta opposed, not delta neutral. Semantics. All right, now let's take a few questions before moving into the long call. As I mentioned, I've done more in-depth comparisons with the in-the-money long strangle versus the married put, a write-up on IBM, a write-up on IWM, and I believe a write-up on Humana, HUM, from a trade that was actually in Kurt's Fishing portfolio. If you would like to see those other write-ups, send us an email to support@radioactivetrading.com. Just say, hey, Mike, I'd like to see the in-the-money long strangle write-ups, and I'll send them to you as an attachment. Okay, very quickly, Thomas wrote in. I'll handle this, and I have to get to Pushkar's question. Thomas wrote in, I missed the first 20 minutes. RPM is writing calls in a married put, right? No. Radioactive profit machine is really consistent of setting up that initial RPM first, the married put position first. Then we wait for the stock to move. Writing a call against it is just income method number 1. We're going to take a look at that in a little bit in the commissions discussion there. Now, you don't always want to sell a call. In fact, in my opinion, that's probably the worst income method that you can use. Okay? For the same reason you point out, what happens if the stock is called in the first month itself? Following the rules in the blueprint, when you set up the married put position, that's the first initial setup of the radioactive profit machine, then we wait for the stock to move to evaluate the best income methods for us. You're right. If I tried to sell a call too soon and the stock moved up and I'd get assigned, I'd have a higher risk on the upside. I don't know if we'll get to illustrate that today, Thomas, but there's other examples of it that are shown in the archived webinars. You never want to sell a call right away, and you never want to sell a call below the put strike price. Those are some of the rules that are in the blueprint. Now, in the blueprint, of course, there is discussion of how to adjust the call. What would you look for to adjust the call? Rolling the call out. When would you look to do that if you had an income method number 1 open and the stock started to move above the strike price of the call and you decided you wanted to keep it for further gain? That's all discussed in the blueprint, and you can get further views of that in some of the archive presentations. I'm not going to get a chance to go too deep into that today, Thomas, but later after the presentation I'll be able to send you an email and show some of those thoughts. Okay. Now I got to do this really quick because we still got to get to the long call discussion and the bonus material. Pushkar wanted to know, let's go position actions. Now let's go to profit and loss chart. I have to do two things here in two separate windows. Okay. Now on Pushkar's comment was, what if I used the in the money long put? Okay, first before I do that, I'm sorry. What if I used an out of the money put with this in the money call? Wouldn't that lower my break even and lower my maximum risk? Let's take a look. June. I'm going to go into the power options chain. I'm going to go to June 20th, historically, and we want to look at our August options. No, our January 2012 options. My apologies. And I'll leave the 5-strike call and put chain for now. Now remember, our stock was at 35.08 closing price. Here's our, let me go to all strikes, put call and put chain. I apologize. Let's do that, shall we? Fantastic. Okay. So here's our 30-strike call. Bid of 710, ask of 735 on June 20th. Now, instead of buying the 40-strike put, remember, where we paid 725, Pushkar might want to know, well, if we bought the 30 call at 735, what if we bought the out-of-the-money 30 put for 212? What would that look like? 30, I'm sorry, January 30 put at 212. Wouldn't this lower our break-even and our maximum risk? Okay, let's take a look. Let's go back to our custom spread builder, our profit and loss chart. Let's clear out the 40 put, view options, January 2012. Now this is current prices. If we look at the 30 put showing 131, but remember, on our date that we're comparing, the cost was 212. One put, 2.12. Ugh, that's a straddle. Okay, that's not really a strangle anymore. Now we're looking at a straddle. Okay, let's go back to the chain. Okay, because the strike prices are the same and the risk is really high, $947, almost 4 times what our risk was in the married put. Now real quick, let's say we're going lower. We did buy the in-the-money 30 strike call. What if we bought the 22.5 put now for, hey, 72 cents? How about that? That's pretty much deep out of the money. Simulate that very quickly. 22 and a, oh, bother. Sorry, ladies and gentlemen. 72 cents. Okay, close that down. Clear. January 2012, 22.5 put. I believe it was 72 cents. What's our risk now? Oh, break-even's of course the break-even's going to lower. It's at 38.07 now. Pushkar, you're absolutely right. But look at the risk. Okay, we did the same strike, which was an out-of-the-money put with the in-the-money call. Now we did an even further out-of-the-money put for a low price. The max risk is $807, and we're just using one contract. Again, the risk is not getting better. Yes, you lowered your break-even. I completely agree with that. You absolutely lowered your break-even, but the risk, Pushkar, is going to be higher. Okay. So when you use an out-of-the-money put within the money call, that's what you're going to end up seeing. Your risk is still increasing. It's even worse than it was with just the in-the-money long strangle. All right. Now, got to move on. If you have any other questions, send them in. We can still handle those. And remember, if you want to see the in-the-money long strangle papers, send us an email to support@radioactivetrading.com. All right, ladies and gentlemen, the big detraction. This setup, what we looked at, the married put position, this setup is exactly the same. It's a parity trade as buying the far out of the money call. Same strike, same month. In fact, the out of the money long call is better. Now, how can something be the same but better? Well, the argument is that buying the out of the money long call instead of the married put is a better use of your capital. But is it? It is if you can be disciplined. Before we go into that comparison, I do want to show you something on RadioActiveTrading.com to give you a little bit more information. We're not going to get into it. I'm going to show my one main argument against why the long call should not be used in the RPM, unless unless you're really disciplined. And we're going to show you why. But first, let me navigate back over. I apologize, ladies and gentlemen. Let me navigate back over, not that one. Okay. I want to go quickly to RadioActiveTrading.com, And I'm just going to show you something. If you want more detailed information on Kurt's comparisons between the long call versus the married put, go to radioactivetrading.com, click on blog. I am going to cover my material, but I just want to show this first. Go to the Radioactive Trading blog, and then run a search for long calls versus married puts. Okay, when you just run that basic search, you're going to have about 5 or 6 articles where Kurt goes through his discussions over time. Some of these go back, I think, to this one goes back to 2009. Long calls versus married puts, married put long call revisited, no free lunch, revisited again, and so forth. Okay, so there's several other ones here, and he talks about the risk-free interest rate and the Black-Scholes calculation. I'm not even going to get into that comparison. I'm not even going to talk about, you know, the prices of the the Black-Scholes pricing model and the free interest rates put into the long call and that. What I'm going to do is just talk about my main argument as to why I don't think the long call is the same as a married put and why I don't think it's better. Okay. Ad nauseum, once more. Married put, 6/20/2011. Buy shares of PXP 3508, 725 is the cost for the 40 put. Total invested is $42.33. Guaranteed by the put is $40. $233 risk, 5.5%. On 6/20/2011, PXP at 3508, we could have bought to open the January 2012 40 call. Why the 40 call? Because it has to be the same strike and expiration of the put if we're calling it a true parity. Okay, long stock plus puts. You know, the argument is the parity trade is the out-of-the-money long call with the same strike and expiration of the put you're buying for insurance. Well, how about this? The closing price of our January 40 call, we're using the closing prices for this discussion as we just saw with that historical chain. The historical price was $2.30 for our 40 strike call. Maximum profit is infinite, unlimited upside with long call purchase. The maximum risk is $2.30. Well, hey, we did it, didn't we? We found a position that has a 3-cent lower monetary risk than the married put position and still has an infinite upside profit potential. So this is it. We're doing better. It must be a superior trade. Well, not really. We saw this before. This was the profit and loss of the RPM of our radioactive profit machine on PXP. This is our profit and loss chart for the long call. Wait, let's go back, and then let's go forward. Okay, it's almost the same chart, isn't it? Looks exactly the same. Infinite risk on the upside, limited risk of 230 or 233 on the downside, and 230 for the call, 233 for the married put position. So these are the same trades. Why wouldn't I just pay $230 to buy a call instead of investing $4,233 to enter into the married put? Because you really wouldn't do that. Let's talk about it. The long call and the RPM have a similar risk-reward profile. That cannot be argued. We just saw it. They look like the same exact menu. The problem comes with the discipline, okay? Proper money management and forcing an ideal size trade. The long call, you risk 100% of your investment. You're risking, if you buy one call contract, you're risking $230 or 100% of the price. Hey, but Mike, the investment's only $230. It's lower than the risk on the married put. Agreed, but is that what you're going to do? Okay, let's take 2 accounts. On the left, I'll write an MP over here. On the left, let's say this is going to be my married put position, and this is going to be our long call. I know I should have had titles there. I apologize that I didn't. Now, in both accounts, we have a total market value of $100,000, not free capital. We have a total market value, total portfolio value of $100,000 might be invested in some other stocks or some other positions. But both accounts are valued at $100,000. Right now, we both have $17,000 of free capital to invest in a new position. I'm going to take a look at the radioactive profit machine, and I'm going to, the RPM cost is $42.33 per share. The maximum risk is $233. Your January 2012 40 strike call is $230, and the maximum risk is $2.30 per contract, or 100%. Now, with my $17K of free capital, I'm going to force myself into a proper size trade. I can only buy 400 shares of stock and 4 put contracts. So I'd invest $16,932. Okay, my total at risk is $932. 400, times 233 is a maximum risk of $932. That represents less than 1% of my whole portfolio. I'm still risking 5.5% of the 16,932 I invested, but this 932 is only risking 1% of my investment. You have 17,000 available capital. You like this position. You can buy 73 contracts. So you're investing 16,790, which works out to a total risk of 16,790 or 16.7%, okay, of your $100,000. Ray, you're one slide ahead of me. Ray wants to know, what if you used discipline and bought only 4 contracts? I'm going to get to that as well. In fact, probably right now. All right, so that's just our comparison. Now, I know this is an extreme example. That was an exaggeration. None of you would ever buy 73 contracts. If you had 17,000 of free capital and you really, really, really liked PXP and you almost had 100% or 95% insurance that the stock was going to move up to $40 per share, okay, let's say $60 per share, which no one has, you might buy 73 contracts. But in reality, you're not going to do that. I know that. I just wanted to really emphasize the problem with overtrading. Let's be honest about the nature of the investor. What if you are disciplined, Ray, and everyone else? What if you are disciplined and you only bought the 4 contracts of that long call? Okay, so your risk would be $920. The $2.30 times 4 contracts would be a risk of $920. What are you going to do with the rest of the capital? Are you going to put it on hold in your account so that you took $920 out to buy the 4 calls? I apologize, you took the $920 out to buy the 4 calls, and you're left with $16,080. Are you going to leave that alone? Are you going to leave that in your account, or are you going to look to buy maybe 4 contracts of XYZ, maybe another 5 contracts of ABC? And you start using that capital in other long call positions, you're still risking more. That's kind of the issue. That's the nature of the investor. We don't like leaving that $17,000. To be honest with you, the reason why I really emphasize this forcing an ideal size trade, because the married put techniques, in addition to limiting my risk, also save me from myself. If I'm doing long calls and I only put in the $920 to buy 4 contracts to be equivalent to the risk of the married put position, if I'm sitting on $16,080 of free money in my portfolio, I know what I'm going to do. I'm going to look for new long calls to buy, aren't I? Maybe I'll trade a credit spread. Maybe I'll buy 100 shares of stock and do a standard collar. I'm going to be reinvesting that money. So now overall, of that $17,000 you started off with, you're not risking the less than 1%. You're risking more. Okay, so there are 400 shares of PXP and 4 puts forces me into that trade. I had $17,000 of free capital. I invested $16,932. I'm forced into any deal size trades, and I'm not going off the tangent and doing other trades. I'm risking 5.5% of my invested capital and less than 1% of the portfolio. By the way, PXP is an RPM that I am in. A little bit different numbers than what we're showing today. But my account value is only about $40,000 that I'm trading in with the RPM techniques. So I opened the position with 200 shares and 2 put contracts, so I'm risking about $400 or 1% of my $40,000. Okay. Now, you buy 4 calls, and the cost would be $920. Your risk is $920 or 100% of what you invested, and still less than 1% of your portfolio. You're risking less than I am on the married put. But this is only a true parity trade if and only if the remaining $16,080 in your account is on hold. Okay? You don't use it for anything else. You don't buy other calls. You don't use that as leverage to do some of the credit spreads or debit spreads. The minute you start adding other positions with the $16,000 that's sitting in your account, we're no longer even close to being a parity. Okay? That's the rule, Ray. That's what you have to watch out. We know the nature of investors. We both like this stock, or maybe you saw me put on this trade and you decided to follow me by buying the 4 calls and you had the $17,000 free. If you use that in any other position, are you really going to be able to sit on $17,000 of free capital for the next 30, 60, or 90 days? I know the nature of the investor, and maybe you are more disciplined than me, and bless you if you are, because you'll do much better in the market. But if I did this and I saw $16,000 sitting in my portfolio not doing anything, I'd be tempted to do other trades with it. And now I'm completely away from the parity trade. All right? That's what I feel is really important with the comparison of the long call. Kurt talks about it in the blueprint, in the Bulletproof from the Beginning chapter. He says, hey, you can do this. You can use long calls instead of the RPM position if you're disciplined enough to only make sure that the calls you're buying, the number of contracts you're buying, are represent less than 1% of your portfolio value, and you keep the remaining capital you would have used to buy stock on hold in your account. That's the only way it can be considered a true parity trade, and Kurt says you can do that. And Glenn, you brought up an excellent point that I also didn't even think about, and it's pretty basic and should have been right on the top of my tongue, but dividends. PXP doesn't happen to be a dividend-paying stock, but Glenn's 100% right. Okay? The advantage of owning the stock is the dividends. Same monetary risk. The only way that you can to be a true parity trade to the married put is by buying the call, keeping the same risk, buying the same number of calls you would buy as shares of stock, and then leaving the stock on hold. That's what I feel is really important. That's where I fear people get into trouble, is over trading, over leveraging. All right, we're at 1 o'clock, but I am going to stay on for an extra 15 minutes. If you have any other questions about comparing the long call, the out-of-the-money long call to the married put from what I just showed, please feel free to send them in. And remember, there's plenty of blog articles on RadioActiveTrading.com where you can go into more discussion of Kurt's discussion on that and arguments on that, as well as join the conversation. Comment on the blogs, comment on the thoughts. Feel free to go to the blog and look up one of those long call versus married puts. Mention this webinar and tell him, say on the blog that I don't think Mike had the right way of it at all. I think he's way off base. Let me know that, and I'll explain again why I don't think I am off base. But I think this is the key, to properly force yourself into an ideal size trade, limit your risk. To be honest with you, this RPM, again, saves me from myself. When I'm in that stock plus put position, I'm not risking over trading. It saves me from myself. Glenn, I'm sorry you have to go. I am recording this. We're going to cover the 2 bonus materials. I'm going to talk a little bit about commissions. I'm also going to talk about in-the-money versus deep-in-the-money married puts as well, which I think you might have seen on last Friday's presentation. So I'll see you. Have a great week as well, Glenn, and I'll talk to you soon. Can you use the RPM as a retirement income strategy? John, that's exactly what Ernie does. Ernie's now retired. Okay, he's trading his account, and he's doing it with the RPM techniques because he was getting destroyed with covered calls. And now that he's retired, of course, this is a much better solution. I can't guarantee that you're going to generate income each month, but I feel it's legitimate that you can make 1 to 2% per month using this protective technique, maybe even more if the stock moves up as you expected, or exceeds your expectations, I should say. But I believe you can do that. Now, everyone has their own goals and their own expectations, and I'm not sure if it matches your goals or expectations. But we really feel, and this isn't just Ernie, who's retired, and he says this to all the retirees that call in and using power options, evaluating the technique. I'm 35, but I use it as well, and I say it as well, that for someone who's retired that doesn't have cash coming in, it's not just about generating income. That's great to do, and yes, I know that's what you want to do, and we want to see you do that. But you are protecting the position. Oh, is the income from capital gains? No, John. After the married put setup, we use 10 different income methods to adjust the position, earn income, lower the at-risk amount, and earn extra profits. That's all described in the blueprint. We're not doing an income method presentation today. We're just doing a comparison and frequently asked questions presentation today. All right. Let's see. Quick summary. These are my and others' thoughts on the comparison trades, but again, if you have counterpoints, let me know. I do feel the RPM is superior to these comparison trades. Every scenario I've run, when I tried to do the calendar put spread to get into the RPM, every scenario I've run with the in-the-money long strangle, with the exception of a stock jumping up 50% or declining 50%, and even with the long call, because it forced the ideal size trades, I feel the RPM is superior. And I also had these same thoughts. Remember, I was the director of education. I knew all of the investment strategies. I was doing condors now and then. I was doing credit spreads, debit spreads, standard collar positions. I traded covered calls and naked puts, wrote a book on naked puts, co-authored with Ernie, and I was doing calendar spreads. And as soon as I saw the basic RPM setup, I had the same thought. Can I do better with a calendar put spread? Can I do better by buying an in-the-money long call and keeping the in-the-money long put? Or isn't it just the same as a long call position? I tried that all, and my opinion, my experience is that it's superior. The RPM is superior for different reasons. And everyone has their own different reasons, but that's why mine is. And you might feel the opposite, and that's quite all right. And as I mentioned, keep the conversation going in the blog or the email. I'd love to hear your thoughts, comments, and ideas. We're not done yet. I knew I was going to be right around 1 o'clock when this came up. So the only place to obtain the full techniques and all 10 income methods is the blueprint. Okay, it's 250 plus pages of investing material written by Kurt, and Ernie has put in a lot of information as well. Teaches you how to properly limit your risk with this setup and proper money management. That's the real emphasis. And of course, it goes into in-depth detail of all 10 income methods. And if you purchase the blueprint, you of course receive the free Support CD, The Foundations of Radioactive Trading, which really goes into those 3 core principles I mentioned, and it comes with a money-back guarantee. Okay, let's see here. Sorry, ladies and gentlemen. There we go. Okay, so let's go back to Radioactive Trading. And of course, if you wanted more information about the blueprint, you can send us an email or give us a call, or go to the Products tab in Radioactive Trading, and you have the information for the blueprint here. The 10 different income methods, combining income methods. You get the bonus is you get a free coupon for your first month of fishing to follow Kurt's trades. It's only $10. That free Foundations of Radioactive Trading CD, and we'll also give you a month free to Power Options. Those are tools I was just using, and we're going to use a little bit more extensively in the next 15 minutes there. Okay, so those are the bonuses that you receive with the purchase of the blueprint, and 100% satisfaction guaranteed. If you're not satisfied with it, just send it back to us. We typically ask you to send it back to us within 30 days, and we'll refund it. The cost is $339 and $11 for shipping, but it comes with the money-back guarantee. Now, if you're just getting started, we're going to take this question. Okay, Thomas wanted to follow up. After I buy the blueprint, do I get any support or recommendations to buy married puts and make the income methods? Well, that's what the book describes, is what kind of married puts would you look for. You have the search tool and the report tool and Power Options to identify the positions, and then you can use the portfolio tool to track and manage those positions. Do you get support? Absolutely. We host these webinars every Tuesday and Thursday at 12 noon, different ones, but you can call us here at Power Options, or you can send us an email to support@Radioactive Trading. I can't give you direct advice on which married put to enter, but we can talk about what your goals are, what you're looking to accomplish, what your risk threshold is, help you set up the search on Power Options to evaluate that, and then run the research and analysis to see what stocks best match that. You have continued support, Thomas, once you buy the blueprint, from Kurt, myself, from Ernie, from Greg, whoever you want to talk to. That's absolutely true. And we don't make recommendations. You can follow Fishin, where Kurt lists his trades for his clients, the Fishin, which you can get for $10, first month for $10. You can follow him, or Ernie. You can actually see Ernie's portfolio as well. You can follow those trades and trade along with them. But we don't treat it as an advisory newsletter service, more of an educational, continuing education service. But yes, the support is always available. Even if you don't buy the blueprint, Thomas, if you have questions, I won't give away what's in the blueprint, but I can clear up some things for you, so you can send us an email and call at any time. All right. What we want to do now, bonus material. Let's talk about commissions. Many have asked how commissions affect RPMs. And this also goes back to that discussion of the income methods and how they're used, and we're going to show that right now. Now, in the archived webinars, back on RadioactiveTrading.com, one of the tabs that you had was for webinars. And the webinar that's archived from June 28th, I believe Kurt shows how Altera made 12% after his income methods and adjustments, and he did an income method number 5 and an income method number 3 and rolled part of the income method number 5. So that sounds like a lot of commissions, but it really only reduced his profit from 12% down to 11.9%. Rather than use the slides, I'm going to repeat something that I did on my open discussion presentation last Friday. I'm going to we're going to use that custom spread tool again to sort of illustrate how commissions would affect the PXP RPM with an income method. Okay, so let's go back to Power Options, and we're going to go back to the portfolio. And we're going to take our married put position for Plains Exploration. Now let's go into the profit and loss chart. There we go. And this again was our position, remember. Bought stock at 35.08, and this is just 100 shares. Bought the put for $7.25. Total invested $42.33. Maximum risk is $233, 5.5%. Now, I have to navigate back very quickly to the portfolio to look at one thing. So far, I've bought stock and bought a put. The stock is continuing to fall today. It's down $1.31 today, much to my chagrin. But right now, the return is $104 or 2.5%. All right. Now, let's remember that $104 or 2.5%. My commissions, I should probably do this on the other page, shouldn't I? I'm sorry, folks. Let me go back here first. My position, okay, 104 and 2.5. My commissions, if I buy stock, my commission is $7.95. And if I buy a put option, my commission is usually around $8.70. Okay? So right now we have a 2.5% gain, 104 divided by 42.33. Now I'm just going to do this on the calculator. I know it's not the best way to do it, but I wanted to do this on the fly instead of have slides prepared in case numbers changed. We have a profit of 104. Let's subtract out $7.95 for my option. Sorry, folks. $7.95 for my stock commission. I'm having a hard day. 104 minus 7.95. Okay. Don't ask. There we go. Okay, so I'm down to 96.05. Now I subtract out 870. So my profit would be 87.35 right now based on the commissions for buying stock and buying put. And of course, if I liquidated right now, I'd have to pay another 2 commissions, wouldn't I? All right, so it would be $7.95 to close the stock. And minus, it's actually less than that, it's minus about $7.95 again for the option if I sell to close it. So now I'm at $71.45, and I still had invested $42.33. Actually, an investment might have moved up to $72.40 with those positions. So let's take that. $71.45 would be my profit right now, including my commissions, divided by $42.33 investment. Oof, 1.7%. So I gave up about 0.7%. 1.7% would be my return to 2.5%. Wouldn't I have the same commissions on a covered call, though? If I traded a covered call with an expected profit of 2.5% at expiration, and then even if I left it to get assigned at expiration, I would have paid the commission to buy the stock, to sell the call, and then also to when I got assigned. Be pretty much close to the same reduction in price, wouldn't it, if I did a covered call? What about a credit spread? Sell to open a call, buy to open a call, and a bear call credit spread, pay 2 commissions there. Well, if it expires worthless, I still had 2 commissions added, but my premium was going to be lower anyway. Okay, now, let's go back for a moment to our custom spread tool. Remember what we discussed. If we were trading in a $100,000 account, we would have forced ourselves into an ideal size trade. We could have bought 400 shares of PXP and 4 put contracts. Let's go ahead and hit submit. Now, income methods. The stock's at 38 right now. I was hoping it was going to stay at around 39 for this example, but it didn't, so it's down to 38. Now, we bought the stock at 35 and it's moved up, and we have 10 different income methods that we could use. Actually, there's only about 6. Maybe 7. 6 or 7 of those can be used if the stock moves up. The others are used if the stock moves down or if the stock stagnates in price. But let's say I was going to follow income method number 1. I was going to sell a call on the position. Okay, we're going to sell 4 calls. Well, the stock's moved up. August is only 18 days away, so let's choose September. And I want to sell the stock's right at 38. I wouldn't do that. I really want to sell the 40 call. So let's go ahead and do that. We're going to sell the 40 call because I don't want to sell a call below the put strike price. This would have worked much better if the stock had stayed at 40. Didn't cooperate for us today. All right. So I'm going to click added, and I'm going to sell 4 contracts of the call at the natural bid of 141. Let's see what that looks like. Remember, our risk was 233, so we're still going to have a 90-cent risk. This is income method number 1. Earlier today, we could have sold it for about 220 when the stock was trading right at about 40 or 39.25. So, okay, that's where that's what we'd look to do. Now, the maximum return, we lowered our risk to 2.3%, and the maximum return, if everything works out as we expected on September expiration, would be 7.1%. Folks, I see you've sent in a few questions. I'm going to address those in just a moment, and I just want to remind you, yes, I did record this presentation. I saw that question come in. It might be posted later on this afternoon or early tomorrow morning. And the other questions that came in, I'm going to get to them, but I just want to cover this first, because we still have another bonus material we might skip today because we're already at 1:15. Okay, so the stock stays right at 40 on September expiration. Our expected return is $1,160 or 7.1%. But what happens? Let's factor in our commissions, okay? So we could have a maximum profit of $1,160 if all things work out at September expiration. Yeah, earlier when we were looking at this, when I was looking at this today, the return was closer to 7.7%, and you know, the limit is 2.3%. John quickly wrote in, you've limited the upside. Why? I'm not saying I would do this trade, John. I'm using this as an example because this is the income method that's given away for free in the sketch. Remember earlier in the presentation, I said income method number 1 for me is my least favorite income method, and I try not to use it. I think it's actually the worst income method to use because we've capped the upside gain and we've made a steep slope here. But this is just about commissions right now, John. This isn't about the income methods. This is one of the 10 income methods. It's not one I regularly use because I have kept the gains. When I do income method number 1 on a married put, John, you're absolutely right. I'm really saying to myself, I think the stock's going to be trading right around $40 in the next 46 days. What am I essentially doing? I'm timing my trade. I am also trading time, but I'm also timing my trade. All right, back to square one. Potential profit of $11.60. Okay. Now, I pay $7.95 for stock even if I buy up to 1,000 shares. So we got to subtract $7.95 for the stock purchase. Oh, that's why it's not clicking on. Okay. Minus $7.95, and I would have paid $8.70 for the 4 puts, and $8.70 for selling the call. Okay, so that takes my profit from $11.60 down to $11.35.65, or from 7.1%. Let's divide it now by 16368. Right, that's our new cost basis on the position after we sold the call. Sorry, the calculator went away on us. All right, this isn't too bad now, is it? See, when you're forcing yourself into an ideal-sized trade is not just about proper money management and limiting the risk. It's also making sure you trade the proper amount. If you tell me that you've made 100, did I actually? I'm sorry. If you tell me that you've made 100% on your latest trade, I'd be so excited for you. But if you told me you bought 1 share of a $5 stock and it moved up to 10, well, what did you really make? Okay. So do commissions have effect on the RPMs? Yes, I can't argue that. When if you're just buying 100 shares in 1 put contract, it's going to show more of an effect. We just saw that with the original one, where we dropped our realized gain on PXP of 2.5% down to 1.7%, a 0.8% decline, because we had only 100 shares in 1 put. The profit we could have made, $104, was reduced by our 2 commissions, and then the 2 commissions we would have paid to potentially liquidate it. But when you force yourself into an ideal-sized trade, you're not just helping yourself benefit from the limited risk in a proper position-sized trade. You're also helping yourself hedge against the cost of the commissions. Okay, 6.93% versus 7.1%. Hey, if that's the cost of doing business, that's the cost of doing business. I can't really thwart that. But again, same scenario. You roll a covered call. You're in a credit spread, and you roll the credit spread. You're going to pay commissions either way. And I don't think once you force yourself into an ideal-sized trade, I don't think the commissions have that effect. Okay, Greg did mention I came in late. Was this recorded? Absolutely. We're going to be posting it later. And this Stanley brings up a great point, of course, that was brought up during the Friday presentation when I showed this for the open discussion. At Interactive Brokers, he pays $1 for 100 shares and between $75 and $1.50 per contract. I'm absolutely not saying I have the lowest commissions. In fact, that's a great point, because if you're using an online discount broker, such as Interactive Brokers, Thinkorswim, maybe even Trade King, Options House, you're going to pay a lot less than I do. This, what I'm showing, are my commissions at Fidelity in my retirement account where I trade the RPM positions. I can't change it over because that's where the retirement account is. Those are some of the rules there. So I'm paying a higher commission. But when I force myself in an ideal size trade, I'm only giving up 0.2%. Again, Kurt made 12% on Atera. It was 500 shares. When he factored in his commissions, he only made 11.9%. Okay. All right. Mark had to leave. It looks like he enjoyed the webinar. Great. We had someone come in late. It looks like A. A said, I missed your comparison of the RPM with a naked put plus long put. Can you summarize? Yeah, let me go back to the slideshow, and I can do that real quick. I'll just show you the last summary page, but again, this is going to be archived, and you can go through it. Okay. Here's the main deal. When we were talking about the married put position that you saw in PXP, at the same time, on June 20th, we could have entered the calendar put by doing the 124. Selling July 35 put for 124 and buying the January 40 put for 725. Total debit is 601, and then you could potentially buy stock at 33.76. But where's the problem? I now have a capped gain, and I have a higher risk, almost 3 times the risk of the RPM, and that is for just 1 contract. Now, when I opened the RPM, I was looking for a stock that I really expected to move up 5 to 8% over the course of the next 30 to 60 days. What I've done here is handicap myself. Okay? As soon as the stock goes above this break even, which is $35 plus the 124, I now have to consider buying the close of the put and buying the stock. Because if it continues up and I got to scramble to buy the stock at 38 or 40, I'm going to have a much higher risk than I would have with the married put. Summary, you're trying to time your trade. You're really saying that I expect this stock to be trading right at this strike price within the next 30 to 45 days, and the next 2 months after that I expect it to move up 5 to 8%. If you could pick stocks on a regular basis that do that, again, you're probably a better trader than I am. We talked about earlier. You need the stock to be trading right at that price. If the stock goes up, you can suffer very large losses, and you may have to scramble to buy stock. Okay? Also, you run the risk of overtrading, and you're starting off with a capped gain to start with, and that's kind of the risk. So that's just a really quick summary, A, on that. When the webinar is posted, you'll be able to look at that later on. Okay, let me do something very quickly here. Let me scroll back through this. I'm sorry, folks. Trying to wrap this up here. Okay. Okay. I think we've covered the questions on the commissions. Oh, no. Oh, geez. Thomas, no, you don't have to change your account to make this work. Thomas does have one at Options House. You do not need to trade. You can absolutely trade there. And, in fact, you'll get better commissions than I will at Options House. So that's good. Just as the gentleman that wrote in had better commissions than Interactive Brokers than what I'm using at Fidelity. All right, last little segment. I want to do this in 5 or 10 minutes. This is actually going back a step to the original RPM setup, not talking about income methods, not talking about commissions. Is lower risk better? Well, yes and no. There is such a thing as too little risk when you first open your married put position, the first part of the radioactive profit machine, that initial setup. If you start off deeper in the money, you might put this too deep in the money and have a lower risk, is it a better trade? Well, it is lower risk, but you're also going to have a lower expectancy of profit. Now let's use Power Options tools to illustrate this comparison in 2 ways. We're going to look at a new RPM comparison quickly, and then a slightly different PXP comparison. Okay, and real quick, Stanley wrote in, there is no commission in Interactive Brokers when you're assigned. I've heard that before, Stanley, and I always forget if it was at Interactive Brokers or Thinkorswim. It might be at both. I'm not positive. But yes, Stanley just informed us that at Interactive Brokers, if you are assigned, or I'm assuming if it's automatically exercised, you don't pay a commission there at Interactive Brokers. That's all something to keep in mind. Okay, how do we identify these trades? Well, using the Power Options tools, that's not the menu I want, that's the menu I want. Using the Power Options tools, we'll go into the Married Put menu and we'll go into the search. Now, these trades that come up when you first go into the Married Put search are not recommendations or suggestions. These are the trades that match the default criteria that Kurt uses that's described in the blueprint. You want to use this as a stepping stone to create your own personal search. Now, these settings here, days to expiration, at least 150 days, to 900 days out in time. We're restricting it to not go more than 20% of the money. Why? And we're going to show that in just a second. And the percentage at risk, we're looking at 3.5 to 9%. Kurt prefers to use the IBD 50 and CanSlim, and we're looking for stocks in an uptrend. Now, you can use that as a stepping stone, but you really want to adjust some of your criteria. For example, in my portfolio, $40,000, my total account value of $40,000, I typically don't buy stocks over $55 per share. So first thing, I'm going to change the stock price. In general, I don't like to take risks of greater than 7.5%. So I'm going to restrict that. Well, not 75. I'm going to restrict that as well. Okay. Now, at times I might not want to use the IBD 50 and CanSlim list. That's personal preference. I might choose to go no list and then use some of the filters here for fundamentals and technicals, such as earnings per share growth, price per earnings, broker recommendation. This is a topic for another time. Okay, using the search tool, there are archived webinars that describe that, and I can walk you through it at any time. Now, let's submit those settings and see what we get, just some basic adjustments. All right. CPX at 38.29, buying the 45 put for risk of 5.4%. Halliburton at 53.66, looking at the 57.5 put for 6.4%. Now, let's take choice number 1. Why not? We'll use CPX. This is not a recommendation or suggestion. This is just a scenario for comparison. We're looking at a put that matches our criteria. I'm going to have to add some columns in here to take a look at that, but it's a 5.4% risk. The stock's almost at 38.29, almost the same price as PXP. And we're buying the January 45 put pretty deep in the money for $9.30. So total investment is $47.59. We're risking 5.4%. One of the other tools on Power Options is the Search by Symbol tool, which will technically show me all, that's the January 2012, of course. It'll technically show me all of the comparisons or all of the available married put positions. And let me go ahead and go all results so we can see all the combinations. Oh boy. Oh, that's not too bad. And I want to add 2 more columns into this. What I'm going to actually, or just 1 more column, I'm going to add, so when I click see more or less columns, what I want to see now is the range in or out of the money. And I also want to see the percentage time value. Now the maximum risk shows this too, but I want to show it also with the percentage time value. Well, let's just, nah, I don't need the percent break even. We'll see that manually. Let's click Save and Return and refresh our page so we have those available. Okay. As Kurt mentioned, there's such a thing as too high of a risk, and there is such a thing as too low of a risk. The stock is at 38.31. Notice how our risks start to get really high as we go out of the money. Okay, so we were investigating the January 45 put at 9:30 with a 5.5% at risk. The 40 put is only about 4% in the money. Okay, but it has a risk of 9.7%. That's outside of my range. When I start going out of the money, the 35 put has a lower cost of $3.60, but remember the stock's going to need to drop $3.31 before that's hit, so our risk is going to be $6.91. What about the 30? Well, it only costs $1.90, but now the stock needs to drop $8.31 for the insurance policy to come in, so that's $10.21 or 25%. Okay, so that's going out of the money. What about going too far in the money? I could buy the January 55 put and pay $17.70, but look, my total debit's only $56.01. We have the 55 put, so I'm only risking $101 or 1.8%. Isn't that what I want? Don't I want to start off with a lower risk? No, this is the scenario where there's such a thing as too little risk. This is why the search tool does 2 things. It's limiting the risk to be greater than 3.5%, but we also don't want to go greater than 20% in the money. That's why the 50 strike wasn't shown. It's risk matches, but we feel it's too deep in the money. Okay, so there's a balance. And if you wanted to take a risk of closer to 10%, sure, this January 40 would have matched what you're looking for. But when I go this deep in the money, yes, I only have a risk of $1 or 1.8%, but in order to apply the income methods correctly, in order to make adjustments on the position, because I'm so deep in the money, I'm going to need the stock to be trading closer to $55. I need the stock to be trading up near $54 or $53 per share. And hey, if that's your expectation of the stock and it comes true, that's fine. But if that's the case, you would have done better with the 45 put anyway because you paid less money to get into the position, and you probably could have done 5 or 6 income methods on the way up to 45. Probably would have been bulletproofed after the first or second income method on the adjustment. So there is such a thing as too little risk. You don't want to go too deep in the money and take on too little of a risk. Last week, on Friday, during the open discussion presentation, ran a comparison with a customer who was evaluating PXP. But he wanted to evaluate it based on his criteria. He honestly told me that he's been trading the radioactive techniques, but he's been having problems making money. And I said, okay, well, what kind of stocks were you doing? And we talked about that criteria a little bit. And then he said, well, I don't take a risk of higher than 2%. Right away, I knew what the problem was. Okay, well, maybe 2.5%, 2% or 2.5%. There is, here we go, deep in the money RPM comparison. And what we basically did, we don't really need to look at the profit and loss charts here. And, ooh, this is actually not the same anymore. This was good this morning. It's not good today, but that's all right. Okay, let's take a look here. In this particular position, the November 41 put was purchased for $5. I can show the original maximum risk. The original maximum risk on this RPM was 5.5%. This is very similar to the position we opened with the January 2012 PXP married put. So we're less than 20% in the money. We have the risk level that we want. The 41 put was purchased for $5 in stock at $38.38. This was roughly around July 1st when we ran the historical comparison. Now his position likely would have opened the, he informed me that he might have bought the November 45 put, which had a risk right around 2.6%. So he paid $7.80 for the 45 put, so the total investment moves up to $46.18, but he's only risking $118 or 2.6%. Where's the problem? Technically, right now, there isn't a problem. I apologize for that. This is sort of the problem of doing live presentations. In this case, since the stock has dropped to $1.36 today from where it opened at about $39.30, we're showing a higher loss on the less in the money put. The deeper in the money put, the 45, this is where protection comes in, right? If you do have the deeper in the money put, you have the lower risk. It reacts more one-to-one with the stock when it declines. Can't look at that. Yesterday at close and this morning at open, when the stock was about 39.37, the liquidation value of this particular position, the RPM put that was only was 41 put with a 5.5% risk, was a gain of about $35, and the put here was still a loss of $4. The deeper in the money put was still a loss of $4. So the stock had moved up as we expected. It was trading closer to $40 or $41. We had an unrealized profit on the radioactive profit machine, the put we would have selected for the RPM position. The deeper in the money put that had the lower risk was reflecting a loss still. Okay, so that's the disadvantage of going too deep in the money. Now, I'm not giving everything away, but the full techniques into why and what you want to look for, of course, are described in the blueprint. But that was just some bonus material, a frequently asked question again. Why don't I want to buy the put deep in the money and only take a point deeper in the money and only take a 0.5 or a 1% risk? Because you're lowering your expectancy of profit. You're going to need the stock to have a much bigger move to have any kind of realized or unrealized gain. And you also have to wait much longer to do an income method. The best time to do an income method following the at-the-money bell curve is if the stock's trading right at your put strike price. I probably could have done an income method or two on this 41 strike put, PXP with a 41 strike put, but by 45, I need the stock to be trading around $44 or $45 to have a really good income method to make it logically make sense to make one of those 10 adjustments. Well, 9 adjustments. Income method number 10 is not necessarily an active adjustment. Anyway, I need the stock to be trading near 45, and PXP hasn't reached the area. It has gone above 40. It's been trading at $40.50. I think it's even traded above 41 at one point, and I would have been able to make an adjustment at that time, but I might not have seen good opportunities with that deeper in the money put, even though it had half the risk, had a risk of 2.6% as opposed to my 5.5%. Okay, so that's just a little discussion there about the going deeper in the money. You want to follow the rules in the blueprint. You really don't want to go more than 20% in the money. Yes, it has a lower risk, but you'll have that lower expectancy of profit. All right, folks, I'm sorry I went a half hour over. I was really trying not to do that. I was trying to keep it right at around 1:15 with the bonus material, but we had some extra questions. I do appreciate you staying with me, and I hope you all got a lot of useful information about the comparison trades of the married put position and some of those bonus materials as well, the commission discussion and going too deep in the money. Now, other frequently asked questions, you think of something later on about the material presented, the radioactive trading techniques in the blueprint, hey, send us an email to support@radioactivetrading.com. We'll be more than happy to help you out. Kurt will answer any questions that you have. And you can also call us during market hours. You can reach us at 877-992-7971. That's toll-free inside the U.S. Or you can reach us at 302-992-7971. Real quick, Ray asked a question that I thought was going to come in earlier when we wrapped up the 3 positions. Ray wanted to know, do you ever talk about portfolio synthetics? No. Part of the reason why is I had 3 radioactive trading investors who, over the last 3 years, who talked to me about using the synthetic stock position. By buying a call and selling a put in the same expiration month to synthetically create a long stock position and use the put. I've never traded that. I won't trade that. Okay, you have to analyze that on your own to see if it's something worthwhile. All I can tell you is I didn't paper trade it. I didn't try to do that when I was first learning radioactive techniques. Of those 3, actually the 3 investors that tried to use the synthetics, each of them after about 2 months went back to standard radioactive profit machines. They stopped using the synthetics. 2 of them I know for a fact are still trading the RPM techniques. One of them is still a Power Options customer. I haven't heard from him in 6 months. I'm not sure what he's trading, but I know he's still actively trading and he's actively using the site. I would assume he's using some form of the RPMs, but he might have moved. He might be trying to do spreads too. I'm not sure, but he did inform me that the synthetics were working out as well. I don't know the reason why, but that synthetic short call plus, am I saying that wrong? Long call plus short put position was not working the same as the RPM. Delta difference or something else, I'm not sure. All right. Jerry, anyone like to form a users group? We're going to be rolling something out, hopefully on Fission Fusion soon for the forum group there, and you can always, I'm sorry, for the forum sort of community group there. Right. Long stock. Oh, okay. So Ray is saying is it long stock and sell a put is a synthetic long call, not a real call. No, I don't know if I would look at that either, Ray. I think it has too much too much risk there. I don't think it's a true synthetic. I've never traded it. I have to look into that, Ray. I've honestly never looked at it. I'll be honest. That's the best answer. I've never looked at it. All right. Well, ladies and gentlemen, again, if you think of any other questions, send me an email. Give us a call during market hours. If you have questions specifically for me, I'd ask that you don't call in the next 10 minutes. I'm going to need a break there. But yeah, please call the office, send us an email, answer any questions that you have, and then we'll compile this presentation for you. Hopefully have it up at the end of the day or early tomorrow morning. Thank you again for staying with me, ladies and gentlemen. Sorry I went a little bit over. We'll talk to you all soon. Take care. Happy trading.